Hello students, welcome to the lecture series on international business. I am Professor Soma Sen Gupta, Kamla Nehru College, University of Delhi. The first lecture of today is International Finance Part 1. In this lecture, we are going to cover the following topics: international financial system, foreign investments, and majorly we will discuss the types of foreign investments and in particular foreign direct investment. International financial system. The international financial system consists of elements which governs its operations. Mainly it is related to exchange rates and the funds flow or the flow of funds from one country to another, and related to that the following things like the laws and rules, agreements, institutions, mechanisms and procedures. International financial system defines the overall financial environment in which multinational corporations operate. It provides the stability in the exchange rates of a country or of all the countries. Now, international financial system also consists of exchange rate arrangements, capital flows, collection of institutions, rules, conventions that govern its operations. So, at the international level, some kind of institutional framework is required which can monitor the exchange rate between the countries and the flow of capital from one country to another, and that is governed by the institutional financial system. International financial or monetary system means the institutional arrangement that governs especially the exchange rates, and in that light we can talk about the international monetary system. So, what is international monetary system? The group of rules, conventions and institutions that administer the international business, trade, investment, and all these are jointly called as international monetary system. The IMS or International Monetary System provides the framework within which foreign exchange rates are ascertained. A foreign exchange rate is the price of one currency expressed in terms of another currency. All of you are well aware of foreign exchange rate, and the international financial system ensures that this rate is clearly defined between the one currency with another currency. Now, what is the main purpose of IFS? Its main purpose is to facilitate the transactions between different countries, because they are not only monitoring the exchange rate but also the flow of funds. A smooth and efficient international financial system is a prerequisite for the growth of international business, because it maintains a decorum or a relationship between the different countries and minimizes the conflicts in terms of exchange rates or investment decisions. Now, what are the essentials of an efficient international financial system? So, let us discuss them one by one. The first and the foremost is easy and quick international payments. So, you are well aware that trading takes place between different countries, and multiple countries and multiple trade arrangements are there. And there you have every country is having a distinct currency. So, we not only we need to know the exchange rate between them, but also the payment mechanism. So, IFS, International Financial System, ensures easy and quick international payments. How it does that? That it facilitates trade as well as the capital flows between the countries. The second is adjusting fluctuations in balance of payment. We have already discussed balance of payment in one of the previous lectures. So, if there is any fluctuations, that can be maintained by the IFS, because it provides a mechanism for adjusting these fluctuations. Then fair determination of exchange rate. So, international financial system also ensures determination of exchange rate through fair play of the market forces with minimal of interference by different bodies. No interference in economic policies of countries. So, international financial system also ensures that though one country may be investing hugely in another country, but there should not be any interference in the economic policies of the individual nations. So, a country which is giving fund cannot impose conditions which are not acceptable on the country which is receiving the funds. Now, the next topic is arrangement of international financial system. There are two major arrangements. One is foreign exchange market and another is government intervention. So, when we talk about foreign exchange markets, market forces of demand and supply govern the exchange rate that we have already discussed. So, this is very helpful in maintaining a kind of a trading arrangement between the countries and payment mechanism, because there is an exchange rate. Secondly, it is the government intervention. Government intervention is necessary whenever there is an exchange rate crisis. So, normally the market forces is taking care of the exchange rate, but if in unusual circumstances, government does intervene to maintain a perfect exchange rate. Foreign investment is our next topic. Now, foreign investment is the flow of capital from one country into another, where investors acquire ownership stakes in assets, businesses or projects. We are well aware that how countries are funding, especially the developed countries are funding the developing or underdeveloped countries in development of infrastructure or turnkey projects, as well as development of the industry in the other country. So, all these are part and parcel of foreign investment. Foreign investment refers to the allocation of capital by individuals, companies or governments from one country into the assets or businesses of another country. Now, you may ask, why the individuals and companies of one country is investing in another country. So, there are different motives behind that. There is definitely a profit motive, because when you are investing in another country, you will get the returns also. And secondly, you are helping in development of that country. So, funds are better utilized. So, it is performing the dual function. One is the earning of profits or return on investment, and the second is balanced regional development of all the nations. Foreign investment form a part of external resources in the process of economic development of a country. Like in India, which is a capital deficient country, and it looks for external resources to supplement domestic resources to finance its plans and projects. India is a big country, but there is a capital deficiency, and that is fulfilled by the external funding in the form of foreign investment or foreign direct investment. This movement of capital can take various forms and serves many purposes, including pursuit of higher return, diversification of investment portfolios. So, another objective of foreign investment beside higher returns on investment is diversification of investment portfolios, like you are not putting all your eggs in one basket. So, you are not only investing in your probably in domestic industry, but you are investing in other countries also. So, you are diversifying your investment, and not only in one another country, or it may be more than one or more than two countries where you are investing. So, for example, China is making huge investment in not only African nations, but also they are slowly capturing the European market also, the Western Europe as well as especially the Northern Europe. Then another reason is fostering economic growth in the host country, that we have said that they ensure balanced regional development, economic growth of the host country also. So, in that way host country welcomes foreign investment in their country, because it will lead to economic growth of that country. Solidifying cross border alliances. So, it also maintains good relationship between the countries. The firm from one country which is investing in another country is building a bridge for the two countries as well. Now, foreign investment plays a crucial role in the global economy by driving economic growth, and not only economic growth, as I said, balanced regional growth, because many of the developing countries are lagging behind, or the underdeveloped countries are lagging behind. They need lots of fund, and that is provided by the foreign investment. Then creating jobs and facilitating the transfer of technology and skills from one country to another. So, it is performing a multiple of objectives are there for foreign investment. Foreign investment has its share of controversy. So, though benefits are there, but there different controversies are surrounding foreign investment. One is the national sovereignty. Now, national sovereignty is compromised when a foreign firm is, or foreign country is hugely investing in another country, because then you have to go by the whims and fancies of that investor. So, in that way there is a problem of losing control over national assets, and national security risk may also be there. Okay. So, we know that many of the ports of Sri Lanka is being it has been developed by Chinese firms, and they have to compromise their sovereignty by allowing the Chinese warship to harbor in the shores of the at the shores of the of Sri Lanka, and this is happening in many of the African countries as well as northern European countries also, because China is hugely investing in these countries, and that is compromising the sovereignty of those countries. Cultural integrity is also questionable in the sense that the indigenous culture does not survive when foreign investment happens in that country. Then economic independence is compromised because more of interdependence is there. So, a country or the firms are overly dependent on foreign funding. So, their independence is since when foreign funding will come, then naturally you will lose your independence as well as control over operations. The control will move towards the firms or the country which are investing in your firm or in your country. Then wealth inequality. Foreign investment leads to wealth inequality in the sense that multinational corporations, they grow, but smaller domestic industry, they do not survive. Likewise, those who are the rich people, they become richer, but the poor become poorer because of because they cannot reap in the benefit of the investment. Exploitation of local resources happen in the sense that when more funds are coming, so more of production is happening, and the local resources are used more and more for manufacturing or production, and that eventually goes to the foreign market. So, local resources are overused or exploited because of foreign investment. Displacement of domestic businesses. Many of the domestic businesses, they couldn't survive because of fierce competition with the multinational corporations or the companies which are getting foreign funding. So, slowly the domestic businesses see their own death. Suspicions about the motives of foreign investors, that is another problem in foreign investment, as if you go through the internet, you will find articles on how China is investing in other countries with ulterior motives of dominating and controlling those countries, and that leads to suspicion. Also, in whenever there is a foreign investment, naturally you have to share your control, and that leads to suspicion also. Now, let us discuss an example of foreign investment, how it takes place. So, for example, in the United Kingdom, foreign ownership of prime real estate, particularly in London, has led to the discussions about housing affordability and the changing character of neighborhood. Now, foreign investment is happening, and the neighborhood area is changing because investment may be there in infra building, in projects. Supporters of particular foreign investment projects meanwhile lend to emphasize the benefits of job creation, technology transfer, economic stimulation that foreign investment can bring. So, whenever there is a foreign investment, there will be one group of people who are in favor of foreign investment, and they will give this logic that foreign investment is leading to not only infra building like but also job creation, technology transfer and economic stimulation. But then other problems may also be there. So, that may lead to uh, uh, questions of foreign investment, uh, questions of whether the sovereignty of the country is compromised because of foreign investment. Now, moving further, let us discuss about the types of foreign investment. We will briefly discuss the types of foreign investment here, and later on some of the topics or some of the sub points will be discussed in detail, the major ones like the foreign direct investment. So, beginning with the simple commercial loan, this is the simplest form of foreign investment. So, loans from banks of one country to foreign business firms and foreign governments is one of the example of commercial loan, and it is genesis in the distant past. So, from past many years this is happening that the banks are giving loans to foreign business firms and foreign governments. Then the second is the official flows. So, financial assistance by developed nations to developing nation is considered as official flow. Also, it provides higher grade technology and facilitate economic management. So, the nations may also invest in other countries. Then foreign direct investment is the most popular type of foreign investment, where investment is made in an enterprise incorporated in another country with the objective of establishing a lasting interest in the investee country. So, the main purpose of foreign direct investment is, of course, investing funds in another country, maybe a new enterprise they will open, or in an existing organization you may invest, but the purpose is long term. That is the basic crux of foreign direct investment. It is not only to make the money and go away, it is about continuous or long term investment in another country or another business. Then another is also flow of fund through multinational corporation and foreign institutional financial institutions takes place in case of foreign direct investment. This contributes to capital formation of that country, because when they are investing, not only, even if they are investing in a company, ultimately people are getting jobs, they are getting income, there are revenue generation, there is a tax revenue also that the exchequer is collecting, all, and foreign exchange of course. All this is leading to development or capital formation in that host country. Then another type of foreign investment is foreign portfolio investment. As the name suggests, these are the companies or investors who maintain a portfolio of investment. That means they are buying shares and debentures of different companies located in different countries and maintaining a portfolio. Their objective is to earn as much profit as possible. So, they want returns on their investment. They are not interested in the development of the host country, or these are not the priority thing. The priority is the portfolio should be rich enough so that it can give the maximum return. So, foreign indirect investment involves investment made by corporations, foreign institutions and private investors in foreign companies registered in foreign stock exchange in the form of shares and debentures. And the last is the qualified foreign investment. Non-resident investors who meet the know your customer requirements of Securities and Exchange Board of India, SEBI, for the purpose of making investment in accordance with the regulations. So, this is a special type of foreign investment, and here we are discussing it from the point of view of investment in India. Then comes the major topic, and that is foreign direct investment. So, out of all these types, this is very important one. So, we will discuss it in detail. Foreign direct investment is an investment made by a company or individual from one country into a business located in another country with the aim of establishing a lasting interest or long term interest. So, we have discussed earlier also. So, the investing company may be located in one country and they are investing in another country or another company in another country, but the aim is long term investment interest. It involves the transfer of not only capital but also technology, skills and management expertise, and is distinct from portfolio investment, where portfolio investment is more of passive investment in foreign equity with the objective of improving the returns. But foreign direct investment not only thinks about generating returns, but also about long term investment in another country, growth of another country. Now, coming to the key aspects of foreign direct investment. These are the key aspects. Long term or lasting interest, as we have discussed, includes multiple components, benefits for the host country, varied types of FDI, there are of different types, and investment routes. So, we will discuss them one by one. First is long term or lasting interest, that we have discussed that the key differentiator from portfolio investment is the intention or intent to have a long term controlling stake in the foreign company. So, it is not for just returns, but long term investment is the motive of FDI. And investment is often defined as direct when it meets a minimum ownership threshold such as 10% of the voting power. Now, it includes multiple components. So, let us see what components are there. So, FDI is not limited to initial capital outlay. It also includes reinvested profits from overseas operations and intra-company loans and borrowings to subsidiaries. So, it may take different forms. Benefit for host country, we have already said that when FDI will come, then what will happen? There will be economic stimulation or development, job creation, development of human capital, increase access to new management expertise, skills and technology. Now, another point is that varied types of FDI are there. So, I am just enumerating it here, we will discuss it later on. FDI can be categorized into different types like horizontal, vertical, conglomerate, platform, greenfield investment and brownfield investment. So, we will discuss them later on. Then the next is investment routes. In some countries such as India, FDI can be made through an automatic route, that is requiring no prior government approval, or a government route which requires prior government approval. So, this is vis-a-vis India. In other countries there may be other rules. So, we have automatic rule or government route. Coming to the benefits of FDI, the first and foremost is overall economic development, and we are talking about the host country. So, FDI injects substantial capital into the economy, funding new businesses, industrial expansion and large scale infrastructure projects like roads, energy, telecommunication, everything happens. So, FDIs are important especially in developing and underdeveloped countries. But nowadays the reverse is also happening, as I said that China is majorly investing in European countries. Job creation in host countries. Economic development due to FDI investment directly creates millions of jobs, which increases local income and consumer purchasing power, further boosting the economy. Technological transfer or inflow happens. Foreign investors bring advanced technologies, managerial expertise and best business practices that may not be available domestically. These innovations often diffuse into local economy, enhancing the productivity and competitiveness of domestic firms and fostering overall innovation. Another is infrastructure development, which we have already discussed that it leads to development of roads, energy and telecommunication. Human capital also develops, so human capital development happens. Employees in foreign owned companies often receive training in advanced techniques and quality control system, which improves their skills and expertise. Also they learn new skills. Skilled workers can train others and contribute to the nation's overall knowledge base and long term growth. capital flow increases, financial stability happens because of FDI, and this also leads to stable exchange rates. Also, there is an access to international markets and export promotion, which happens because of FDI. Competition increases, consumer choice will be there. So, backward, and also we have talked about the development of backward areas or balanced regional development. And all these leads to globalization all the more. So, globalization is FDI promotes globalization by serving as a primary channel for cross border movement of capital. So, if we summarize the whole topic, so what we find is that international financial system consists of elements such as laws, rules, agreements, institution, mechanism and procedures, and the essential of IFS is easy and quick international payment, adjusting fluctuations in BOP. Foreign investment is the flow of capital from one country into another, where investors acquire ownership stakes in assets, businesses or projects. Types of foreign investment includes commercial loans, official flows, FDI, FPI and qualified foreign investment. FDI made by a is a investment made by a company or individual of one country in another country, and the benefits are economic development, technological inflow, development. These are certain references that I've been giving you, C.B. Gupta's book, Sumati Verma's, EPG Pathshala's, Chaturvedi, Hill, Hult, all these are there. So, I believe you have understood the topic. We will continue with that in my next lecture. Thank you, students.